to introduce Tom Ferguson, who will be our first keynote speaker. So just a quick bit about Tom. He's the managing partner at Burnt Island Ventures, which is a specialist early stage venture fund for the $900 billion water sector. As a new generation of technologies and services are emerging to meet society's water needs, they need informed early capital to build the foundations of their early business. Burnt Island Ventures is designed to identify and support the entrepreneurs and technologies that can transform water management, access, and security globally in the face of climate change. Prior to Burnt Island Ventures, Tom ran programming at Imagine H2O for 6 years. 6 years. He holds an MA from the University of Edinburgh and an MBA from Harvard Business School. So Tom, please take it away.
Thank you very much indeed, Ali. That's very, very kind. Yeah, as I said, my name is Tom Ferguson. I'm the managing partner of Burnt Island Ventures. Really, the idea is for us to be the best water entrepreneurs' first phone call when they're raising their first dollar of outside capital. So I went full-time on this at the end of October 2020, and so far we've made 6 investments totaling 5.3 million, and that will, or at least should be 6.7 million by the end of the month across 10 companies. So it's been a relatively fast start. And I want to spend a little time on how we see the opportunity in water. To a lot of the people that I saw on the list, a lot of this is not going to be news, but I think it's helpful context, especially for those in the room that aren't as au fait with what we do. And then move on to some advice that's tailored to the founders and entrepreneurs in the room, but I think is pertinent to anyone building or running a business. It's really important that I give a shout out quickly here to 2 people in particular, Christine Boyle and Victoria Fram. Christine Boyle is a member of my advisory board, and Victoria Fram has taken the unenviable task of being my venture capital mentor for the last 8 months. So great to see you both here. And then shout out to Team IH2O, obviously, who I worked with for 6 years. And then also really sort of fantastic members of this community. Great to see Blue Tech Research and Mazarine Ventures here, as well as Xylem, PepsiCo. You know, during my time at Imagine H2O, you've all been fantastic partners for us. So thank you for being here. So, seed stage water investing. Why did we go after this opportunity? And at its core, it's about this graphic, which is repeated really across the world. Demand is simply outpacing supply, and it's not happening in 5 years or 10 years, it's happening now. The mega drought in the Southwest is very serious indeed. And if you look at the levels of Lake Oroville, it's now below where it was at the height of the California drought in 2016. The Sierra snowpack, which is essentially California's largest reservoir, by the way, I'm being California centric because that's where I am. It provides California with 30% of its water supply and is receding at a record rate. And these patterns are repeated across the world. And this is the result. So US intelligence estimates that global demand will exceed current sustainable supplies by 40%. Now, I'm not that smart, but this is the kind of graphic that I think it's reasonable to invest behind, because innovation has to be a big part of our continued existence on this planet, no matter what else happens. I really think that this is unidirectional. Water is at the bottom of Maslow's hierarchy of needs, and there are no substitutes. And these are market fundamentals. I'm okay hanging my hat, and by hat I mean financial and professional future on. Water is a collection of very large markets. As Ali said, 900 billion in total that are about to undergo enormous and, to our view, inevitable change in the coming decades. Ali, if you could move the slide on one. Sorry about that. From municipal drinking water provision to the most intense industrial processes, these are all vast markets that will increasingly be forced to be dynamic. Now, dynamic is not usually a word associated with the water sector, but we're seeing a pace of change across a variety of verticals that we have not seen before. So we're here because of simple building blocks we think can generate excellent returns for our investors, because we have better founders, and 6 of them here this evening, operating in better, more dynamic and fundamental markets. And we think there is going to be a better market for purchasing these companies, giving us our exits to the investments that we make over the next 3 years within 7 to 10 years, our liquidity window. And so with that background, I want to turn to tonight. Now, the wonderful MIT team asked me to have a think about what might be useful for the founders to hear. And I decided I wanted to talk about themes and ideas that are often talked about, but equally often forgotten in the live fire of building a company. So I wanted to talk about the year ahead. And I feel like now I'm 6 months into the journey of being a founder, I can say all of what follows with even more empathy than I did when I was with Imagine H2O. Because in the year ahead, all of you, founders and your founding teams, all of you will be faced with exceptional challenges, but your only way through is to make good decisions at the margin. How you react to each subsequent challenge will dictate your outcome. So I want to talk about three things. I want to talk about risk, excellence, and DNA. So starting with risk, and the first thing I want to say is that most people think about entrepreneurs as these great risk takers, off into the brave new dawn, willing the world to bend to their will. Jobs acolytes. Now that's 180 degrees wrong. Great entrepreneurs hate risk, hate it. They want to take off as much risk as possible before they make key decisions. That's why they talk to customers, conduct interviews, prototype their products, spend small before spending big. That's why they act like scientists, proving out hypotheses as far as possible before laying their bets. But there's a limit to this. No matter how much work you do, there is always residual uncertainty. The world is unpredictable. Pandemics, wars, stock market crashes, Peloton recalls, Dogecoin. And the lesson from these events is not that you or we missed some indicator that was obvious in retrospect and will never make that mistake again. With thanks to Danny Kahnemann, the lesson is that the world is inherently uncertain. And the only thing that you as founders can do is to do the work and actually do it, not kid yourself you've done it after conducting 20 interviews, and then adjust for the risk landscape. So how do you do that? How do you adjust for the risk landscape? The answer is to think in bets. And if you haven't read the book of the same name by Annie Duke, you absolutely should. So you have to assess the data you have about your market, and also the data you know that you don't have, assess the resources at your disposal, try and estimate the risk of getting punched in the head by the unknown unknowns, and then choose the best risk-adjusted pathway to the outcome you want. Now, that may be global domination and a centi unicorn, in which case you most likely will want to and have to be repeatedly aggressive. But it may also be to work towards cash flow break even early and have the future in your own hands, a much less aggressive series of bets. Now, the best thing about thinking in bets is that it scales. The way in which you think about key decisions now is the same way as you think about key decisions in 9 years' time when you have $200 million in revenue. There's no difference in the structure of the decision, just a change in the inputs, especially the resources at your disposal, because the larger the resources get, the more aggressive you can be without putting the whole company at risk. And that's obviously a key advantage of scale. But just remember that sometimes the world goes against you. Like 80-20 bets fail 1 in 5 times in the long run. So don't beat yourself up if the world goes against you, as long as you learn something and don't go out of business as a result, even though you are at one point or another likely to going to have to bet the company, because anything multiplied by 0 is 0. Know what you're doing and why. There are no sure things, and your decision making should reflect that. Now, excellence. I've spent 6 years being pitched to on a regular basis, and it's striking the extent to which this word is overlooked. Excellence is worth pursuing for a bunch of different reasons, and I want to hit on 2 specifically here. Now, the first thing is that it's awfully competitive out there, and you shouldn't underestimate the breadth of your competitive set. So take capital provision, for example, the business we're in. If you're pitching Burnt Island Ventures, you're not pitching against your direct competitors in your chosen vertical. You're competing against all the other potential destinations for that capital. And that means that you're competing against all other water startups. Now, with us, you have the luxury of focusing solely on the water sector. But if you're pitching lower carbon capital or Congruent or SJF or the other great clean tech investors, you're pitching against every other clean tech company. And if you're pitching Y Combinator or First Round or a 4 or the other top tier seed funds, you're competing against every other startup. And finally, if you assume that the bar for startups is always going up, you have to be amongst the best prospects the investor has ever seen. I don't want to scare you, but this is a very, very high bar. So you should never give anyone a reason not to think you're amazing. Design matters, logic matters, structure matters, writing matters. My pitch deck took me 3 months of solid effort between August and October last year, and it still isn't where I want it to be. Don't tell my investors. Set the bar for everything very, very high. And the great thing about this idea is that if you take it seriously, you get rewarded in the long run, because you can't help but build a brand through excellence. Now, brand building is a bit of a weird idea, because enduring brands are built almost passively as the result of a long track record of being really, really good. Now, you can SEO and design and fancy website and do all the window dressing to try and give yourself an advantage to your brand out the gate. But true brands are underpinned by consistent quality. Nike, Apple, Lego, Marvel, Yo-Yo Ma, LeBron James, all of them are a function of high quality, low variance, so very narrow brand consistency over a long period of time. And a strong brand is a consistently underestimated source of long-term advantage if you keep at it. Just ask Warren Buffett and his attitude towards companies as diverse as See's Candies to Apple. And so on to DNA. If you think about your company as an organism, the DNA is the instructions that are handed on to the elements of the expanding entity as it grows. So this is how we do things. This is what we stand for. This is what's important to us. These are our standards of quality. This is how we treat people. The explicit and implicit instructions that are passed from the CEO on out. And I want to touch on 3 of these that are consistently important. Firstly, talking to your customers. There is no substitute for setting a habit, a muscle memory of speaking with your customers, especially as the CEO, as often as possible. And don't lose sight of this as you grow. Like, what do your customers care about? What's their experience with the product? What works? What doesn't? Where else can you help? You need this input now, and you need it forever. I don't know if anybody else has ever emailed Jeff at Amazon.com. In fact, it probably doesn't work now. He's the executive chairman. But that stuff really does work. Secondly, and this sounds a bit weird, but be careful of convenience, especially early in the company lifetime. Now, you're taught to look for hacks, for shortcuts, but you already have a ton of them. Cheap laptops, AWS accounts, SEO credits, 3D printers, Zoom. That can't lead you to try and avoid what's important for you to learn. When I started the BIV raise, I had multiple offers for capital raising professionals to help me shorten the road. And I said no, because I mean, A, it's expensive, and B, I have to learn how to sell this idea. I have to go through the pain. I have to learn the resiliency that comes from fundraising. But equally, this should come for you from selling a product, looking after the first customers, dealing with suppliers, hacking through the spit and sawdust days, going through these experiences rather than looking for ways to reduce discomfort. And the most common way is looking for a distribution partner to sell something for you. Going through this stuff is an underrated endeavor. Thirdly, if you think about your DNA as a transmission mechanism, be very careful of who you choose to transmit it. Now, companies are just a group of people taking a sequence of decisions that result in actions that result in more decisions. Who you let inside to take those decisions and actions matters. So be careful, because the wrong people will mutate your DNA in ways you do not want. And if you do let the wrong person inside, take immediate action with no wishful thinking. Be ruthless. And this is something we look for in all of our founders. So that's risk excellence and DNA. And I just want to talk directly to the emerging CEOs now, because this is a really hard job and you really have 3 responsibilities. And thanks to Fred Wilson for his classic articulation, which often has key parts overlooked. And so on the next slide, you can see first that you set the overall vision and strategy for the company. Most people only get that far, but the second part is by far the more important, and communicates it to all stakeholders, internal and external, from board members to intern. You have to communicate it effectively. Like my personal favorite is the metronomic update, first of the month, without fail. I think every founder should do it, and we expect this of BIV companies. Second, recruits and hires. Now, I think it's interesting that the recruits and hires are separate, but so far so good. But the bits that gets missed is and retains the very best talent for the company. People matter, and you have to hold on to good people. And third, that you make sure that you always have enough cash in the bank. Now, that one's simple, but not easy. But to those 3, I would add a 4th. look after yourself. Your companies rely on you to do the other 3 jobs well, and you can't do any of them well if you're a mess. So lean on advisors, friends, parents, loved ones, therapists, your house plants, whatever it takes, because companies are sequences of decisions. And if the key decision maker isn't bringing their A game, the rest of it doesn't matter. So good luck, Godspeed, and thanks for having me. Best of luck this evening.